Namaste. In this video, we are going to discuss IND AS 102 that talks about the accounting treatment of share-based payment. It has been a practice over the years by listed entities as well as non-listed entities to issue shares and options as a part of remuneration to its employees. It is considered as a good practice because it saves the cash cost to the entities. So instead of providing the cash, in lieu of cash, they issue the shares to the employees. Apart from it, it is also considered as a good governance practice because issuance of shares and options to employees helps promoting significant long-term shareholding, specifically by senior management, and is holding long-term holding of shares also align their economic interest with those of the shareholders. Apart from issuing shares to employees, nowadays specifically startups issuing shares to suppliers also to obtain the goods and services. Increased use of share-based payment method resulted into an accounting controversy across the globe. Shareholders were of view that entities are getting their services and goods and issuing the equity instruments, and it is resulting in diluting their shareholdings in the group, and it is not being recorded in the books of accounts. To address this issue, IFRS 2 was issued in 2004 and later on it was amended according to the requirements. And it was decided that these transactions will be recorded in books of accounts. IND AS 102 deals with these transactions, and the objective is to specify financial reporting by entity when it undertakes a share-based payment transactions. Share-based payment transaction is when entity or group entity receives goods and services from its suppliers or employees, and in return there is an arrangement to dilute the liability by share-based payment arrangement. There are some exclusions to 102 that where transfer of equity instruments that are clearly not payment for goods and services, transactions with shareholders in capacity of shareholders, and transactions those are covered by other indices like IND AS 32, 109, 111 and 103. Let's understand what the share-based payment arrangement is. So IND AS 102 says that it's an arrangement between entity and another party, it may be supplier or employees, that entitles other party to receive either cash or other asset that is based on the price or value of equity instruments of entity or group entity or any other enterprises. So here it is called cash settled transactions. So these transactions are paid in cash, but the price of remuneration is defined based on the price or value of the equity instruments, and these transactions are classified as cash settled transactions. Another method may be equity instruments, where enterprises issues the shares or share options to supplier or employees, and these transactions are classified as equity settled transactions. So in the first transaction, the remuneration is defined based on the price or value of the equity instrument but is paid in cash. In the second one, entity issued the equity instrument, not cash. This is very important to identify whether transaction is cash settled transaction or equity settled transaction, because the accounting treatment depends on the type of arrangement, whether it is cash settled transaction or equity settled transactions. These transactions may depend on some vesting conditions. So we need to check whether vesting conditions has been fulfilled or not. For example, there may be a condition at the time of issuing ESOPs to employees that employees have to stay in organization for a period of 5 years to become entitled for the ESOPs. So apart from identifying the type of arrangement for remuneration of services and goods, we need to check the vesting conditions have been fulfilled or not. Next topic of discussion is the recognition of share-based transactions. It is about the timing of recognition, that when it has to be recognized. If the transaction is in respect of the goods, it will be recognized when goods are received by entity. And if these transactions are in respect of services, it will be recognized when services are obtained. Next question arises, how it has to be recognized. So in previous slides, we have discussed about the classification of the share-based payment transactions. Accounting depends on the classification of the transaction. If these transactions are classified as cash settled transactions, in that case, we will debit asset, inventory or expense, whatever is the nature of goods or services that we have received, and will create liability. If the transaction is classified as equity settled transaction, in that case, debit entry will be remain same as we have discussed in cash settled transactions. But in case of credit side, we will book as increase in the equity. This is basic recognition criteria that we have discussed. So let's break them down more specifically in line with the various type of transactions in next slides. Let's look into the equity settled share-based payment transactions. When an entity receives goods and services from its suppliers or employees and it is going to settle that liability in form of equity shares or options, then we have to look that how it has to be measured and what will be the measurement date and what will be the recognition date. So the Ind AS 102 provides two different treatment. One is for the employees and another for the non-employees. So in case of employees, as it is difficult to determine the fair value of services received, so Ind AS 102 says that it has to be measured at fair value of equity that we are going to provide to employees against the services received. And in case of non-employees, it has to be recognized at fair value of goods and services received. So measurement will be always on fair value, but in case of employees, it will be fair value of equity, and in case of non-employees other than employees, it will be fair value of goods and services received. In case of measurement of employees liability, it will be measured at grant date, and in case of non-employees, it will be measured at date on which goods and services are received. In case of recognition date, it is similar in case of employees and non-employees, and it will be recognized on the date when goods and services are received. Let's discuss another important aspect of equity settled share-based payment transactions when it is done with the employees. Here we need to understand that grant date plays an important role in recognition of liability. Ind AS 102 defines grant date when both parties agrees to share-based payment arrangement and provided that specified vesting conditions in arrangement are satisfied, and if this arrangement is subjected to the approval, that approval has been granted. So there is no specific guidelines in Ind AS 2 to define the grant date. So each entity may need to consider its specific facts and circumstances for deciding the grant date. Here, it may be noted that grant date is relevant for the purpose of measurement of fair value of equity settled share-based payment transaction with the employees. It is not necessary that recognition of services received under share-based payment transaction will also start from the grant date. There may be cases where employees have started to provide the services but grant date is not defined. In such cases, the entity estimates the grant date, fair value of the equity instrument for recording the expense. And once the grant date is decided, the equity trues up the expense so that it is based on the grant date fair value of the award. So this is very important factor that we need to take care. Another non-ignorable aspect in equity share-based payment transaction is vesting conditions. So these conditions may be time-based. For example, an employee has to be in organization for a period of 5 years or 3 years, or it may be on performance based. For example, that entity has to achieve the profit target of 10% or cost reduction target of 10%. So these vesting conditions are important in the payment of share based transactions, because based on meeting these conditions, it will be decided that when expense to be recognized, it means timing of the expenses to be recognized, and the measurement of expense is also dependent sometimes on vesting conditions. Apart from it, sometimes reversal of expenses is also depend upon the vesting conditions, that expense that we have already recognized, but due to the upcoming years, the condition is not fulfilled, so we may have to reverse these transactions. These vesting conditions may be further divided. We have to check whether condition determine the remuneration. If it does not determine the remuneration, in that case, it will be called non-vesting condition. In case it determines the remuneration, it will be called vesting condition. Vesting condition may be based on the service condition, may be further classified in service condition if it depends on the length of the service to be done. And another classification may be in performance conditions. Performance condition may be further classified based on, if it is based on the market conditions or other conditions. So when determining the equity settled share-based payment transactions, we need to define or determine whether it has the vesting condition or it determine the remuneration. Based on that, the timing of expense, measurement of expense, and reversal of expense will be determined. Next topic under equity settled share-based payment transaction is modification, cancellation, and settlements. In some cases, entity modify the plan because it is too onerous to achieve to the holders of the equity, and it is not going to have fruitful to the holder during its lifetime. In that case, modification is done. Example of modification may be reducing the exercise price of the instrument, or increasing the numbers of the instruments, or reducing the vested period, and elimination of certain conditions. Those are making it tough to achieve the target. So in case of modification, if it is increases the fair value of the equity, the cost, incremental cost will be booked in the remaining period. And incremental cost will be measured at increment fair value at the modified date. And incremental fair value will be calculated by reducing the modified instrument fair value from the original fair value of the instrument. So difference of both of the instruments will be called as an incremental fair value at the modified date. In case vested period is changed, in that case incremental cost is recognized for the services received from the modified date to the vested date. But in this case, Ind AS 102 does not specify whether changes should be accounted retrospectively or prospectively. In case of non beneficial modification by way of reducing the ESOP's total fair value or any other way that is not beneficiary to the employee, the treatment will be consistent with beneficial modification that we discussed in previous slide, and it is based on the principle that incremental fair value is zero or is not negative, not generating any income. So this transaction will be accounted for as below. If reduced fair value is there due to the modification, we need to ignore that transaction because IND AS 102 prevents an entity from modifying an award in order to reduce the overall PL charges. For example, if because of the modification the fair value is reduced, in that case we should not book the reduced expenses in our books of accounts. If modification reduce the number of equity share that to be granted, we need to account for as cancellation for that grant portion. Now let's discuss about second category of cash settled share based payment transaction. In this case, we need to measure the liability at fair value, and unlike the grant deed model for equity settled award for employees, an entity need to remeasure the fair value of liability at each reporting date until it is settled. Further, we need to check whether it is having vesting period. If it is not having vesting period, we need to recognize full cost, and if it is having vesting period, then cost will be recognized over the vesting period. Any change in the value of the liability will be recognized in profit and loss account. And where an entity cancels or settles a cash settle award, it should be de-recognize the liability. Next topic is share-based payment awards with cash alternative. In this case, accounting depends on the choice whether it is with counterparty or with the entity. If it is with the counterparty, then it is to be treated as a compound award and it need to be split in debt component and equity component. First, we need to define the debt component based on the fair value of debt, and difference of the fair value of total instrument minus the debt instrument will be defined as an equity component. Debt component will be treated based on the cash settled share price transactions, and the equity component will be settled as equity settled share based transactions that we have discussed in the earlier slides, and debt component will be remeasured at settlement date. In case choice lies with the entity, in that case either it has to be booked as a equity or as cash. So to decide whether it has to be booked as equity or cash, we need to check whether there is a present obligation to settlement in cash. There is a present obligation to settle in cash if there is choice of settlement has no commercial substance. It means, for example, the entity is prohibited from issuance of shares, or there has been past practice of cash settlement, or there is stated policy of entity to settle in cash. If these three conditions are there, it is to be considered as a cash settlement and to be booked as cash. Otherwise, it has to be booked as a equity treatment. Next topic is group share based payment arrangement. These are the cases where services or goods are provided to an entity in a group, but the obligation is settled by another entity. In this case, IND AS 102 provides a clear basis to determine the classification of share-based payment transaction in both separate financial statements and consolidated financial statements. An entity that receives the goods and services should account for awards as equity settlement if and only if the awards granted are entities on equity shares, or the entity has no obligation to settle the share-based transaction. Let's understand it with the help of graph. So we need to check whether counterparty gets my shares. If answer is yes, it is equity settle expense. If answer is no, then we need to further check, does counterparty get equity instrument of another entity in same group? If answer is yes, then we need to check whether am I settler of the transaction? If answer is yes, it is cash settle expense. If answer is no, then it is equity settle expense transaction. In case counterparty get equity instrument of another entity in same group and answer is no, then we need to check, does counterparty get cash or other assets based on the value of either my entity instruments or group entity? In that case, if answer is no, this is not in scope of 102. And if answer is yes, and next question is, am I settler? Similar to these transactions, if answer is yes, it will be treated as cash settled transaction. And if answer is no, then it will be treated as equity settled expense. This is all about IND AS 102 share-based payment. We have discussed it in summary form. If you want to know more or we need to discuss further queries or have any clarification, you may contact on the WhatsApp number given on the screen. Thank you very much for watching the video. Thanks. Namaste.